I'm about to reveal 12 financial principles that will completely rewire how your brain processes money decisions. And fair warning, some of these insights are going to make you feel a little uncomfortable because they'll expose the lies you've been telling yourself about wealth for years. My name is Nick, and I've spent countless hours dissecting the hidden psychology behind why smart people make terrible money choices, why broke people stay broke even when they get windfalls, and why the wealthiest individuals often look nothing like what you'd expect. If you've ever felt like you're working harder than ever, but your bank account isn't reflecting that effort, or if you've wondered why financial success feels like chasing a moving target, smash that subscribe button because we're about to decode the mental operating system that controls every dollar you'll ever earn, save, or lose. Here's what most financial advice gets completely wrong. It assumes you're a robot who makes purely logical decisions based on spreadsheets and calculators, but humans don't work that way. We make financial choices based on emotions, past experiences, and psychological patterns that were programmed into us long before we ever saw our first paycheck. Today, we're going to expose those patterns and give you the tools to work with your psychology instead of against it. Let's start with a revelation that might sting a little. Lesson number 1, nobody is actually crazy when it comes to money. I know what you're thinking. What about the person who bought GameStop at $300? What about your uncle who keeps buying lottery tickets? What about the neighbor who panic sold everything during the last market crash? They seem pretty irrational, right? Here's the thing. Your financial worldview is shaped by maybe 0.0000001% of what's actually happening in the economy, but that tiny slice of reality forms about 80% of how you think money works. If you grew up during the Great Depression, you hoard cash. If you came of age during the dot-com boom, you chase growth stocks. If your parents fought about money every night, you either become obsessed with financial security or you completely avoid dealing with finances altogether. The person who seems to be making crazy decisions isn't crazy. They're responding logically to their personal experience of how money works. When you understand this, you stop judging other people's financial choices and start examining your own psychological programming. What experiences shaped how you think about risk? What stories did your family tell you about rich people? Those narratives are running your financial life whether you realize it or not. This brings us to lesson number 2. Enough is one of the most powerful concepts in all of finance. Here's a question that will keep you up at night. When you have enough to live comfortably, why do you keep pushing for more? I'm not talking about basic needs here. I'm talking about the relentless drive to upgrade everything once you've crossed the threshold of genuine comfort. The problem with not defining enough is that you'll risk everything you have to get more of what you don't need. Think about it. How many people do you know who have risked their reputation, their relationships, their health, or their peace of mind to accumulate wealth beyond what they could ever reasonably spend? The hedonic treadmill is real. That promotion you're chasing will feel normal within 6 months. The bigger house will become just your house. The luxury car will become your daily commute. But here's what's insidious about not having an enough threshold. You'll keep moving the goalposts. First it's 6 figures, then it's 200,000, then it's 1 million. The target keeps shifting because you never stop to define what enough actually looks like for you. Meanwhile, you're sacrificing the present moment for a future satisfaction that neuroscience tells us will never actually arrive. The wealthiest people I know aren't the ones making the most money. They're the ones who figured out their enough number and then focused on protecting what they had instead of risking it for more. This isn't about being unambitious. This is about being strategic enough to know when you're playing with house money. Lesson number 3 is going to challenge everything you believe about intelligence and success. Compounding doesn't require brilliance. It requires time and consistency. We live in a culture that worships the genius move, the brilliant insight, the perfect timing. But wealth building is actually the opposite of that. Warren Buffett started investing when he was 10 years old. not because he was a child prodigy, but because he had access to information about investing early and he started putting money away consistently. By the time he was 30, he had $1 million. By 59, he was worth nearly $4 billion. Today, he's closing in on $150 billion. Okay, but here's the kicker. If he had started at age 20 instead of 10, his net worth would be dramatically smaller today. The math of compounding is ruthless in its simplicity. Small amounts invested consistently over long periods will always beat large amounts invested sporadically over short periods. This is why the person making $40,000 a year who saves 15% consistently will often end up wealthier than the person making $100,000 who saves irregularly. But our brains hate this reality because it's boring. We want the shortcut, we want the secret strategy, we want the stock pick that doubles overnight. Meanwhile, the real wealth builders are doing the most mundane thing imaginable, putting money into boring investments month after month after month for decades. This connects directly to lesson number 4. Plan for your plans to fail spectacularly. Mike Tyson had a saying that everyone has a plan until they get punched in the face. Your financial plan is going to get punched in the face repeatedly. The question isn't whether bad things will happen. The question is whether you'll be financially prepared when they do. Emergency funds aren't sexy. They don't generate returns. They just sit there in a savings account earning almost nothing while inflation slowly erodes their purchasing power. But that boring pile of cash is what keeps you from having to sell investments at the worst possible time or from having to go into debt when life inevitably throws you a curveball. The people who build lasting wealth aren't the ones who optimize for the best case scenario. They're the ones who prepare for the worst case scenario while hoping for the best. They structure their finances to be unbreakable rather than optimal. Because when the unexpected happens, and it will, survival matters more than maximization. This leads us to lesson number 5, which might be the most counterintuitive insight in all of finance. True financial genius looks incredibly boring from the outside. There's an old saying about pilots. Flying is hours and hours of boredom punctuated by moments of sheer terror. The same principle applies to smart money management. A good definition of financial genius is doing the average thing while everyone around you is losing their minds. When markets are crashing and people are panic selling everything, you're buying more. When markets are soaring and people are borrowing money to buy overpriced assets, you're taking profits. When everyone is chasing the hot new investment trend, you're sticking with boring index funds. This type of discipline looks easy from the outside, but it's psychologically brutal in the moment. It requires you to act against every instinct your brain has developed over millions of years of evolution. Your brain wants you to run when others are running and chase when others are chasing. Fighting those impulses consistently over decades is what separates the wealthy from everyone else. The financial media will never celebrate this type of boring consistency because it doesn't make for compelling content. Nobody clicks on an article titled, "Man Continues to Invest in Index Funds for 32nd Consecutive Year." But that headline represents the strategy that creates more millionaires than any other approach. Lesson number 6 is where things get interesting, and it's probably going to make you question every career decision you've ever made. The ultimate form of wealth isn't money, it's freedom. Freedom to wake up when you want, freedom to say no to projects that drain your soul, freedom to spend Tuesday afternoon at the park with your kids instead of in a conference room pretending to care about quarterly projections. Most people optimize for income when they should be optimizing for autonomy. They take the higher paying job with the longer commute, the bigger title with more responsibility, the promotion that comes with golden handcuffs. But here's what's fascinating about human psychology. Doing something you love on a schedule you hate can make you despise what you once enjoyed. I've watched brilliant people become miserable because they traded their freedom for a bigger paycheck. They got trapped in lifestyles that required them to keep earning more just to maintain what they'd built. The fancy house demanded the expensive mortgage, the luxury car required the hefty payment, the private school tuition locked them into jobs they couldn't afford to leave. Meanwhile, the person making half as much but living below their means has something these high earners don't: options. When your boss becomes unbearable, when your industry gets disrupted, when you want to take a sabbatical or start something new, having a low cost of living gives you the freedom to make choices based on what you want rather than what you need to afford. This brings us to lesson number 7, which is going to hurt if you've been using material possessions to signal success. Nobody cares about your stuff as much as you think they do. When you see someone driving a Tesla, you don't think that person is cool. You think the car is cool, and you imagine how cool you would look driving it. This is a crucial distinction because it reveals something uncomfortable about human psychology. We buy things to impress others, but others aren't actually impressed by us. They're impressed by the object, and they're imagining themselves owning it. You're essentially paying tens of thousands of dollars to be a walking advertisement for a brand, while people fantasize about replacing you with themselves. Real wealth is invisible. It's the money sitting in investment accounts that nobody sees. It's the paid off mortgage that doesn't show up in your Instagram photos. It's the ability to write a check for unexpected expenses without checking your balance first. The wealthy understand this distinction between being rich and looking rich. Being rich means spending money on expensive things. Being wealthy means having money. These are often opposite behaviors, which explains why so many high-income earners have surprisingly low net worth. They're optimizing for the appearance of wealth rather than the accumulation of wealth. Lesson number 8 is mathematics disguised as common sense, but somehow most people get this backward. Your wealth has almost nothing to do with your income and almost everything to do with your savings rate. This sounds obvious until you realize how we actually behave. We celebrate the person who gets a raise, but ignore the person who cuts their expenses. We admire the entrepreneur who increases revenue while overlooking the one who improves profit margins. We focus on the top line while the bottom line determines our financial future. A teacher making $50,000 who saves 20% will often end up wealthier than a lawyer making $200,000 who saves 5%. The math is simple, but the psychology is complex. Increasing income feels like winning. Decreasing expenses feels like losing, even though they have the same mathematical effect on your net worth. Here's what makes this particularly insidious. Every dollar you don't spend is a dollar that can compound over decades. Every dollar you do spend is gone forever. So when you buy the expensive coffee every morning, you're not just spending $5, you're spending the $5 plus whatever that money could have grown into over the next 30 years. This leads us to lesson number 9, which will save you from the exhausting game of trying to predict the unpredictable. Time in the market beats timing the market, and it's not even close. The statistics on this are almost comical in their consistency. If you invest money in the stock market for one day, you have roughly a 50-50 chance of making money. Over 1 year, your odds improve to about 66%. Over 10 years, you're looking at 88% odds of positive returns. Over 20 years, data shows positive returns in nearly every rolling 20-year period in history. But here's what's beautiful about this progression. The longer you stay invested, the less your timing matters. The person who invested at the worst possible moment in 2007, right before the financial crisis, still came out ahead if they held on for a decade. Meanwhile, the person trying to time the perfect entry and exit points usually ends up buying high and selling low. Your brain hates this reality because it wants to feel in control. It wants to believe that with enough research, enough analysis, enough charts and graphs, you can outsmart the market. But decades of data show that even professional fund managers with their teams of analysts and sophisticated models fail to beat simple index funds about 85% of the time. This connects directly to lesson number 10, which reframes market volatility from a problem to be solved into a price to be paid. The stress, uncertainty, and sleepless nights that come with investing aren't bugs in the system. their features. They're the admission price for long-term returns. Think of market volatility as the fee you pay for the privilege of participating in wealth creation. Just like you pay fees for Netflix or gym memberships, you pay the volatility fee for access to compound growth. The people who can't stomach this fee, who sell when markets drop and miss the recoveries, end up paying a much higher price, the opportunity cost of not participating in long-term wealth building. The beautiful thing about understanding volatility as a fee is that it changes how you react to market downturns. Instead of seeing a 20% drop as a disaster, you see it as the market sending you a bill for future returns. You're not losing money, you're paying for the service of wealth accumulation. Lesson number 11 might be the most important insight for making smart financial decisions in a world full of conflicting advice. Your situation is completely unique, and advice that's brilliant for someone else might be catastrophic for you. Financial advice often comes with implicit assumptions about age, income, family situation, risk tolerance, and time horizon. The aggressive investment strategy that makes sense for a 25-year-old single person might be terrible for a 50-year-old supporting 3 kids. The conservative approach that protects a retiree's nest egg might be too cautious for someone with 40 years until retirement. This is why cookie-cutter financial plans fail so spectacularly. They assume everyone has the same goals, the same constraints, and the same psychological makeup, but a decision that keeps one person awake at night might help another person sleep better. The key is understanding your own unique combination of circumstances and designing a plan that fits your specific situation. Finally, lesson number 12 is going to disappoint everyone who thinks investing requires complexity and sophistication. Simple investing beats complicated investing almost every time. Low-cost index funds plus decades of patience will outperform the vast majority of sophisticated strategies. This frustrates people because simplicity feels like you're not trying hard enough. But the evidence is overwhelming. Most actively managed funds fail to beat their benchmark indices over long time periods. Most complex investment strategies underperform simple buy and hold approaches after accounting for fees and taxes. The investment industry has a vested interest in making you believe that successful investing requires expertise, sophisticated tools, and constant monitoring, but the math tells a different story. The person who buys a broad market index fund and ignores it for 30 years will likely outperform the person who spends those same 30 years researching individual stocks, timing market moves, and chasing the latest investment trends. The reason this works isn't because the market is predictable, it's because human behavior is predictable. We overcomplicate things when we're scared, and we chase complexity when we're greedy. The person who can resist both impulses and stick with boring, simple strategies ends up winning by default. But here's where it gets really interesting. These 12 lessons aren't just about building wealth, they're about building a relationship with money that doesn't make you miserable in the process. Because what's the point of accumulating millions if you spend decades stressed, anxious, and obsessed with numbers on a screen? The people who master these principles don't just end up with more money. They end up with more peace of mind. They sleep better at night knowing their finances can weather storms. They make decisions based on their values rather than their fears. They understand that money is a tool for creating the life they want, not the scoreboard that determines their worth as human beings. And that brings us full circle to something most financial education completely ignores. Money is emotional before it's mathematical. Every dollar you spend or save carries psychological weight. Every financial decision you make is filtered through years of programming about what money means, what it can do, and what you deserve to have. The person who understands this has a massive advantage over the person who thinks investing is just about picking the right stocks or finding the perfect allocation. They recognize that their biggest enemy isn't market volatility or economic uncertainty, it's their own psychological tendencies to make decisions based on fear, greed, and social pressure. This is why so many financially successful people look nothing like what you'd expect. They're not driving the flashiest cars or wearing the most expensive clothes. They're not obsessed with the latest investment trends or constantly checking their portfolio balances. They figured out early that wealth building is primarily a psychological game disguised as a mathematical one. The math is actually pretty simple. Spend less than you earn, invest the difference consistently, don't panic when markets drop, and give compound interest decades to work its magic. A middle schooler could understand these concepts in about 10 minutes. The hard part is executing this simple strategy consistently for 30 or 40 years while your brain screams at you to do something, anything, other than the boring thing that actually works. The hard part is watching your friends buy houses and cars you can't afford while you're maxing out retirement accounts they've never heard of. The hard part is staying disciplined when markets crash and financial media is predicting the end of capitalism as we know it. Look, if these 12 principles made you uncomfortable, good. That discomfort is your brain recognizing that you've been playing the wrong game this entire time. The beautiful thing about understanding the psychology of money is that you can't unknow it. Every financial decision you make from now on will be filtered through this new awareness of how your mind actually works when it comes to wealth. Stop chasing complexity, stop trying to impress people who aren't paying attention, and start building the kind of boring, sustainable wealth that lets you sleep peacefully at night. If this rewired how you think about money, hit that subscribe button and share this with someone who's still trapped in the old way of thinking. I'll see you in the next one.